There are two types of joint accounts. There's joint tenants in common. This is an ownership designation where two or more individuals may hold fractional interest in an undivided asset. At the death of one of the tenants, the decedent's interest passes to his or her heirs, not to the other tenants. So if you have a situation, let's say that your client wants to own assets with their brother, but they don't want to own them equally, and they want to make sure that if they should die, that their portion of the ownership passes on to their children, they would want to title the account joint tenants in common. The other type of a joint account is called joint tenants with right of survivorship. This is an ownership designation whereby the entire asset is owned by two or more individuals equally. So, joint tenant with rights of survivorship. The ownership is equal. At the death of one of the tenants, the decedent's interest passes to the survivors. So generally speaking, husband and wife will own an account under joint tenants with right of survivorship. A pay-on-death account, also called Totten trusts or informal trusts, are a simple and inexpensive way to put bank deposits and some securities in trusts for your heirs. If you've ever had this happen, one of my girlfriends recently lost her mother, and she had the hardest time executing the estate because she couldn't access any of the bank accounts because they weren't titled payable on death accounts. If you have a bank account, you always have the option of naming your bank account, checking account, savings account in this manner. So basically what a POD account does, or sometimes they'll refer to it as a Totten trust, is it says, let's say my dad set one up, in the event of my dad's death, I would be the beneficiary, or my brother, or we'd both be named, but one of us needs to be able to access those bank account assets without having to go through this whole process of providing a death certificate. It can really tie up the money if it's not titled a POD account. U.S. government securities can be held in a POD account. A client can also name a beneficiary on U.S. savings bonds. Most states allow brokerage accounts to also be set up in a very similar way, such as a transfer on death account. Not all states allow this, though, so you need to check the rules of your state. When you have a payable on death account or a transfer on death account, it allows the assets to pass to the heirs and probate is avoided. While my dad's alive, if it's a POD account as the beneficiary, I have no ability to access those assets while he is alive. It's true that my dad could change the beneficiary on the account at any time. To claim the assets in the POD account, I will still have to provide a copy of the death certificate and prove who I am. So the POD doesn't really get us out of having to provide the death certificate. Wills generally cannot override a POD account. So if a client's estate is to be split evenly between the client's two children, but the son is listed as beneficiary on a POD account, the assets in that account will go to the son, no matter what the will says. Trading securities. There's different types of orders. Most of the orders that come across the floor of the exchange specify no price. What we call those are market orders. So it's a market order to buy or it's a market order to sell. If you're buying for your client, you want to buy at the lowest price you can. If you're selling for the client, you want to get them the highest price that you can. So market orders specify no price. The order ticket itself specifies the type of order, buy or sell, the type of security, the number of shares, price qualifications, such as limits or stops, the client's name and account number, the date of the order, long or short, whether discretion was exercised, and the registered representative's identifier. So all of those items are found on the order ticket. They like that on the test. I need to do a chart for you. I need to explain a concept of what are called stops and limits. So most of the orders that come across the floor of the exchange are what we call market orders. But there are some orders that are held in the books of the specialists that are away from the current market price. Those orders that are away from the current market price are called stops and limits. So we need to have a basic understanding of what are stops and limits. So let's say that the market price is $40. The orders that exist below the current market price can be remembered with this funny acronym of OBLOS. I remember if I bought the stock at 40 and I sold it below 40, I'm going to have a loss. OBLOS. It's just something silly. It helps me remember. So what does this stand for? And I promise I will explain. This is an open buy limit and an open sell stop, which we sometimes call this one a stop loss. I'll explain, don't worry. So let's say that you're eyeing a company's stock and you want to buy it, but it's not quite low enough. And you don't want to have to check every day the price of the stock. Who has time? So there's this order that you can enter that's called an open buy limit. That in an open buy limit, you specify a price. So if the current market price is 40, an open buy limit must be below 40. Anywhere below 40. So let's just make up something and say you enter an open buy limit at 30. What that means is that if the market price gets to 30 or better, which when you're buying is lower, so if it hits 30, stays at 30, or goes lower, then you will buy. But if it never gets there, you will never buy. An open buy limit. It's free to enter. So it's almost cooler than options. Because when you buy a call, you have to pay a premium. You do not have to pay anything at all to enter an open buy limit. If it's executed, yes, there's transaction costs associated with it. But it's free to enter it. So an open buy limit, it might never get executed. And there's this idea that this limit will never become limits, never become market orders. This will make more sense in just a second. So I'm going to put it up there. Trust me for a second. I'm going to go over here and then we'll come back. So if the market price gets to 32, did you buy? No. If it gets to 30 and stays at 30 or gets to 30 and goes lower, now you buy. You only buy if it gets to 30 or better or lower. An open sell stop. Let's say you have an inventory position in a stock. So you're long a stock. You own the stock. And, well, let's just say you bought it today at 40. You hope the stock goes up. You are bullish on the stock or you would have never bought the stock. If the stock price starts to go down, the best thing you can do is limit your loss. So you decide that you're going to enter a stop loss, an open sell stop. And you could do it anywhere below the current market price of 40. Let's say you enter an open sell stop at 36. So you enter an open sell stop at 36. What that means is that if the market price should hit 36, the stop becomes a market order. So if this trigger price is hit, stops become market orders, which means that if it gets to 36, the order is now sell. At what price, you don't know. All you know is that they're going to do it as soon as they can. They're going to sell the stock. The price might have gone up and the price might have gone down. But that's it. You want out. It's a sell stop. So if it hits 36 and then it goes to 32 and you sell at 32, well, at least you got out of it. It hits 36, you could sell at 37. It just becomes a market order. The stop becomes a market order, which means you're going to sell at the next market price, which could be more or less. So if you followed the flash crash, which happened a while back now, there was this huge market gyration, this huge downward fall very quickly, and then an upward rise. So what had happened, there was a lot of people that had their stop losses out there, and it went through the stop, so it became a market order, and then by the time it was actually executed, it sold above the stop, which is highly possible. It could happen. The flash crash day was a fairly abnormal event that we're trying to ensure doesn't happen again. But that's how that situation works. Now, there's one more potential question in this area as far as a stop loss goes. Let's say that you took an inventory position in the stock a while back, and when you bought the stock at 20. And now the stock's at 40. And you don't really want to sell the stock because you're still bullish on the stock, but you're worried that if the price starts to go down again, you want to take your profits. Which of these orders could you enter, either an open buy limit or an open sell stop, to protect your profits? Open sell stop. If the price started to go down again, the stop price was triggered, it would become a sell order at the next market price, thereby taking your profits. So that's another way they could talk about a sell stop. So we know that stops become market orders when the trigger price is hit. Limits never do that, meaning that the limit will never happen down here when you're buying unless it gets to this trigger price of 30 or better, which is lower when you're buying. So ob loss is on the bottom of our chart. So what's on top? There are orders that exist that are above the current market price. We can remember them with a funny acronym of OBSOSL. Just say it, OBSOSL. It sounds funny. It just helps you remember you gotta do something. There's so much to know. So, OBSOSL, what are these? Open, buy, stop, and open, sell, limit. So these exist above the current market price. So we'll put the current market price back at 40. An open buy stop. Remember that if you were someone who believed in charting and graphing, you were a technical analyst, the highest the price has been is called resistance. And there's this idea that if the stock price breaks through resistance, it's going up. And if you enter an open buy stop, let's say you enter an open buy stop at 45, if it breaks through, it's going up. So you want to buy it if it hits 45. So the stop, if the market price gets to 45, it just becomes a market order. And you buy the stock. It's kind of like grabbing onto the back of the train as it explodes and goes up, if you will. So open buy stops. There's one other good use for these, but I'll do that in just a moment. I had a girlfriend who was day trading while her daughter was little, and she told me this story. She said, you know, I'll buy a stock, and then I get sucked into my computer, and I can't go off and enjoy my life because what if the stock price goes up or down? She just didn't know what to do with herself until she learned how she could use the open sell stop to hedge her downside risk. And one of the hardest things to do when you're long a stock is to sell it, because you think it's going to continue to go up, and she had the hardest time actually letting it go and taking her profits until she realized that if she took the stock at 40, she bought the stock at 40, she was happy with, let's say, a 10% profit. So she'd enter an open sell limit at 44. So what that means is that if the market price gets to 44, or when you're selling higher, then she would sell and she would take her profit and she didn't have to stare at her computer anymore. So we know limits never become market orders. So if the market price never got to 44 and stayed at 44, or went 44 or higher, she never sold her stock, which was fine, because she only wanted to sell it if she made whatever percentage she was comfortable with. So OBSOSL, open buy stops and open sell limits. There's one more thing that this open buy stop is good for. An open buy stop is the best way to hedge a short sale. You don't even know what that means yet. So there's a couple of terms that I need to explain to you. If you are long a stock, it means that you own the stock. So that one's not hard. But if you short a stock, what that means is that you have sold a share you do not own, but a share you have borrowed. You sold a share you have borrowed. If you're long a stock, you are bullish on that stock. If you short a stock, you are a bear. You think that the market price is going to go down. One of my favorite examples of this was after the Enron disaster. Kenneth Lay was on trial, and it was brought to the attention of the jury that his son was shorting Enron. Daddy didn't know. Right. That's a terrible story what happened there. But to short a stock means that you think that the market price now is high, so you sell shares that you don't own with the hopes that the market price will go down. And when the market price goes down, you cover your position. So when you short a stock, you're going to have to deliver those shares back to your broker-dealer. If the market price goes down, you cover, you're happy, you win. Yay! The risk is that the market price could go up. You could buy a call to hedge your short sale, but when you buy a call, you have to pay a premium. So an even better way to hedge your short sale is to enter this open buy stop. So let's say that you just shorted a stock at 50, and you enter an open buy stop at 51. So if the market price goes up, you have upside risk on a short sale. If the market price goes up, the market price hits 51, your stop becomes a market order, and you buy and you cover that position. You limit your risk. This is always a test question. An open buy stop is the best way to hedge a short sale. Something else that the test will like about short sales is the fact that they can only be done in a margin account. Short sales must be done in a margin account. If you're going to be long a stock, you can be long a stock to own a stock in a cash account where you pay 100% for the price of the stock, or you can be long a stock in a margin account where you borrow up to half. To short a stock must be done in a short margin account. That concept is definitely on the test. So you can only short a stock in a margin account. Your short margin account is comprised of three things. There is the credit balance. There is what we call market value short, which is how much it would cost to cover the short sale to buy that stock, equals your equity. Federal Reserve Board Regulation T sets the initial margin requirement in a margin account. Federal Reserve Board Regulation T. Regulation T is 50% or $2,000, whichever is greater. Whichever is greater. That's what it is. Sometimes the test question might say Regulation T is 60%. All they're trying to do is see if you understand what it means. They're not trying to trick you. Regulation T is the initial equity that must be deposited in the account. It's not how much you borrow in a long margin account. It's how much equity you must have in a short or a long margin account initially. 50% or $2,000, whichever is greater. So that's Regulation T. It is possible that the broker-dealer can have a higher initial margin requirement. They can have a higher house margin requirement is what it would be called. They can do that. But we're just going to work with the 50%. So let's say that you just shorted 100 shares at $50 a share. So you sold 100 shares, that's one round lot, at $50 a share. So your credit balance is made up of two things. Your short sale proceeds, this is what you made, short sale proceeds, plus your Regulation T. So Regulation T, we said, is 50% or $2,000, whichever is greater. So 50% of 5,000 is $2,500. Your credit balance is $7,500. So this is cash that's actually in your account right now. Your credit balance minus the market value short. The market value short would be if you were to go into the market and buy those shares to cover this position. So you just shorted them at $50 a share. So if you were to buy them, it would cost you $50 a share. So credit balance minus market value short equals your equity. This is what you just deposited. Now, what are you hoping and praying happens to market value short? Do you want it to go up? Or do you want it to go down? Be careful. In a short account, you want market value short to go down. Remember, you're a bear. So if market value short goes down, then your equity will go up. At that point, what I would suggest is cover your position. Buy that stock, take your profit, and be done. You have risk that the market price could go up. There is an ongoing equity requirement in a short margin account of 30%. I'm not concerned that you know how to figure all of that out. It is 30%, but I don't expect that that will be on the test. But the concept of the higher that the market value short goes, the worse for your equity is definitely something on the test. How could you limit your upside risk in a short margin account? You could either buy a call or you can enter an open buy stop. That's the best way to hedge the upside risk. See, I told you that would come in handy at some point. So that is your short margin account. I told you that long means you own a stock. You can own a stock in a cash account or you can long a stock in a margin account. To buy a stock on margin can only be done in a margin account. That makes sense. To short a stock can only be done in a margin account. We talked already about the rule as far as FINRA has a rule for settlement of a transaction that's called regular way. FINRA rule, it used to be an NASD rule, regular way settlement is T plus 3 business days, where your client has to settle the transaction. That's what we call regular way settlement. In reality, along comes Federal Reserve Board Regulation T, which gives them another 2 days. It says that they have the trade date plus 5 business days to pay, which that's true. 5 business days to pay. If they haven't settled by the 5th business day, the broker-dealer will be forced to freeze the account for the next 90 days. Any subsequent transactions must be paid for in cash in advance. And they're going to sell off this position. If they lost money, the client's going to owe them money before the broker-dealer's ever going to do any business with them. So Federal Reserve Board Regulation T plus 5 business days to settle. FINRA's rule regular way settlement is T plus 3. So you really tell your clients that they have T plus 3, and then if they haven't paid you, you're going to hunt them down and fine them because they really have 2 more days. The broker-dealer doesn't want to have to freeze their account. If your client tells you that they would like to engage in margin transactions, there is risk to be in a margin account. Growing up, my parents had friends that used to own Arctic Cat. They sold Arctic Cat for shares of the company's stock that bought them, millions of dollars of shares. Put them all in a long margin account and lost everything. Nice Midwestern folk. It's a terrible story, but it can happen. Margin accounts are risky. So make sure that you're only using these if your clients understand the risks involved in a margin account. Option trading is much less risky. When you buy an option, what's the most you can lose? The premium that you paid for it. In a margin account, you can lose your shirt. So they're very risky. They're not suitable for everybody. There's a hypothecation agreement that must be signed by the client promptly after the initial transaction in the account. The hypothecation agreement is where the client is pledging their securities as collateral for the loan. So I'll show you how this works. There's also a margin agreement that the client must sign promptly after the initial transaction in the account. So those are 2 kind of weird laws that we'll see in the law section of the course. The margin agreement sets forth the interest rate that the broker-dealer is going to charge the client for the loan. Basically, a margin account is borrowing 50% to buy stock. So the broker-dealer makes money here by charging the client interest. So the margin agreement sets forth the interest. It sets forth the maintenance requirements. There's a 25% ongoing equity requirement required for a long margin account. So let's look at a long margin account. Let's say that you decide to buy 100 shares of stock at $80 a share. So the formula in our long margin account looks like this. It's market value long minus the debit balance, this is the loan amount, equals your equity. So market value long, what we're buying is $8,000 worth of stock. How much do we have to deposit under Regulation T? 50% or $2,000, whichever is greater. So that means we must deposit, the initial margin requirement is $4,000. The other $4,000 is going to be loaned to us by the broker-dealer, who in turn rehypothecated our securities and pledged them as collateral for the loan that they got from a bank. That's how all this works. So what am I hoping in a long margin account? I'm hoping that the market value long does what? Remember, anytime you're long a stock, you're bullish. You're hoping that it goes up. So if market value long goes up, for example, now it's at $10,000, the amount that I owe on my loan is $4,000, and now my equity is $6,000. maybe it's a good time to sell, pay off the loan and take your profit and be done. Because what kind of risk do you have in a long margin account? It's great if it goes up, but what could happen? It could go down. So if it goes down enough, you will have what's called a margin call. To meet a margin call, you're either going to have to deposit cash. If you don't have cash, you can deposit fully paid for securities. And if you don't have those, they're going to sell your securities right out of your account, which is how my parents' friends lost all those shares of stock. So margin accounts are risky. They use leverage. They do. They allow you to use leverage, but options offer even better leverage. They expose your client to a fair amount of risk. It's important to remember that new issues can never be purchased on margin. You can never buy a new issue with borrowed money. Securities have to be in the hands of the public for a certain period of time before they become what we call marginable securities. When a corporation sells stock for the very first time, they do that in an IPO, an initial public offering. The shares are sold in the primary market at a fixed price. So this is familiar. We've talked about this before. Shares are sold at the public offering price. If you work for an investment banker that's taking a company public, you cannot buy those shares for yourself. You cannot sell those shares to your immediate family members. It's called an IPO for a reason. Those shares are sold to the general public. Anytime you sell a new issue, you must give out a prospectus. That's because of the Securities Act of 1933. Prospectus is the summary of the registration statement. The latest you can give out the prospectus is the due date of confirmation. The confirmation is sent the business day after the trade date. We sometimes call this primary market transaction an issuer transaction because most of the money goes to the issuer. So this is when the stock is brand new. After the stock is brand new, it trades in the used stock market. It trades in the secondary market. So there's two secondary markets that we're concerned about for the purposes of this test. There's the New York Stock Exchange. So this is an auction, and the trading is done by the specialist on the floor of the exchange. So the specialist's job is to maintain a fair and orderly marketplace for that company's stock. They act in a dual capacity. They match the buyers and the sellers. And then if there's a seller but there's no buyer in the marketplace, they'll have to trade out of their own inventory. So it's an auction marketplace. The over-the-counter marketplace, the NASDAQ, this is a negotiated marketplace. The National Association of Securities Dealers automated quotation system. So this is a negotiated marketplace. This is where the dealers enter the bid and the ask price. So the dealers enter a bid and an ask price. This is the price in which the dealers are willing to do business with each other at. So the broker-dealer. So in order to have your Series 6 license or have your Series 7 license, you must have a sponsor broker-dealer. When the broker-dealer is acting for their customers in an agency capacity, they charge a commission, which must be disclosed on the confirmation. They're acting as a broker. When they take an inventory position in a stock, when they make the market, this is what we call a principal transaction. This is when they're acting as a dealer. This is what we call a market maker. So it's the market makers that enter in the bid and the ask price. So the ask price is the least any dealer is willing to sell the stock at. So they sell the stock to another dealer. The bid price is the most any dealer is willing to buy the stock at. So the bid price, the difference between the bid and the ask is called the inside market or the spread. The narrower the spread, the more active the issue. The narrower the spread, the more active the issue. So your customer buys at which of these prices? The customer always pays the ask. The customer pays the ask. So the dealer's willing to sell at the ask, but the customer buys at the ask. Does that make sense? So be careful there. It's just like on a mutual fund share. When you buy an open-end mutual fund share, you pay the ask. When you redeem, you get the bid. So the customer, when they sell their stock, they receive the bid. Now, if the broker-dealer is acting in an agency capacity and they're buying a stock, the customer is going to pay ask plus a commission. If the broker-dealer is acting as a broker in an agency capacity and the customer is selling the stock, the customer is going to receive the bid price minus a commission. But what happens when the broker-dealer is acting out of their own inventory and buying or selling to the customer is that they're going to charge the customer a markup if they're selling out of their own inventory. So the customer buys at the ask, the dealer's selling to the customer at the ask, plus a markup. If the broker-dealer is buying the stock from the customer for their own inventory, they're going to buy the stock at the bid minus a markdown. So markup and markdown, those terms are used when the dealer is acting with the customer for their own inventory. If they're simply buying and selling for the customer, then they're going to charge a commission. This is when they act as a broker. The commission must be disclosed on the confirmation. So the New York Stock Exchange, generally speaking, is made up of the blue chip stocks. There are listing requirements for companies to trade on the floor of the exchange. The over-the-counter marketplace is technology heavy. It's where more of the growth stocks will trade. There are some rules as far as within the NASDAQ system where certain companies' stocks trade, but I'm not concerned. You won't have questions about what makes it trade on the pink sheets, for example. You won't have anything like that. What determines the price of a stock in the secondary market? The market does. Supply and demand. There are other exchanges and markets that you should at least be aware of. There's the American Stock Exchange. On October 1st of 2008, the New York Stock Exchange Euronext completed its purchase of the American Stock Exchange. BATS is another exchange here in the United States. So there's more exchanges now than there has ever been historically. BATS is the third largest U.S. equities marketplace. Direct Edge would be the newest of the U.S. equities exchanges. The CBOE is the Chicago Board of Options Exchange. This is where most standardized listed options trade. Options also trade other places, but most of them trade on the CBOE. There are also regional exchanges. The Chicago Stock Exchange, the National Stock Exchange. There used to be a Boston and a Philadelphia, but those were purchased by NASDAQ in 2007. The Pacific Stock Exchange was purchased by the NYSE in 2006. There's also international exchanges. So, like I urged you earlier on in the course, it's nice to pick up those financial publications and you'll see all of these different exchanges that exist. We have this global economy these days. So there's an exchange in Japan, and there's an exchange in Australia, and there's an exchange in Belgium, and there's an exchange in Hong Kong, and you'll see references to all of these different exchanges in the financial publications. In order to take your Series 7 or Series 6 examination, you must have a sponsor broker-dealer. So this sponsor, your broker-dealer, this is the firm. So the firm, in order to be a broker-dealer, fills out what's called Form BD. And the broker-dealer either acts in a transaction with a customer as a broker or as a dealer. When they're acting for their customer, buying and selling securities for their customer, and they charge a commission, that's which side of this transaction, which side of this business entity. That's the broker side. If they're acting for their own account, that's the dealer side. So let me ask you a question. Why would you ever be long a stock? Why would you personally ever buy a stock? Why? To make money. Yes? It's the same thing for dealers. Market makers make money on their inventory position. They don't take an inventory position to make money by making a markup, charging a markup or a markdown. No. The broker makes money on the commission, yes, because that's all they do. They don't have any risk. They charge a commission. The dealer makes money on their inventory position. Test question. Makes money or hopes to make money on their inventory. That's why they take an inventory position. So they enter the bid and the ask in the over-the-counter system, making the NASDAQ system work.